In this video, we're going to walk through bonds payable transactions using the effective interest method. We're going to calculate a bond's issue price, prepare a bond amortization table, and prepare journal entries related to issuing the bonds and several of the coupon payments. Our first bond we're going to find is going to be issued at a discount because investors demand an effective interest rate of 12%. But the stated interest rate on our bonds, that is, the interest rate that we're paying in terms of our annual or semi-annual coupons, is only 10%. Doesn't look like a very good bond, so it's not likely we'll be able to sell them for their par value or face value. They will sell at a discount. Let's go ahead and take a look at these bonds. We're told that the Celine Dion Company is issuing bonds with interest payable on January 1st and July 1st, so semi-annual interest payments. And they're using the effective interest method for amortizing the premium or discount. The par value of the bonds is $600,000. The stated interest rate, again, what the bonds pay, is 10%. It has a 5-year term, and the effective interest rate, what investors demand, is 10%. Again, since investors demand an interest rate higher than the effective rate, we will sell them at a discount. We can calculate the issue price of $555,839 using Excel's present value function or your financial calculator. We're going to take the effective interest rate of 12% and divide it by 12, so we have 6% for the interest rate. The number of periods for our bond will be the 5-year term times 2, or 10. The payment, again, is the face value of $600,000 multiplied by the 10% stated interest rate, so $60,000 per year. It's a semi-annual coupon bond, so the payment on our bonds is $30,000 every period. The face value will be the bond's maturity value or par value of $600,000. And again, we solve for that issue price. And we will debit cash for $555,839. We always credit bonds payable at their face value of $600,000, and the difference is our plug, the debit to discount on bonds payable for $44,161. In essence, we are prepaying interest on these bonds by accepting a price lower than the $600,000 we will return to the investors at the time of maturity. Let's go ahead and take a look at our bond amortization table. It begins with the bond's net carrying value, the issue price of $555,839. Again, we're going to pay cash every period of $30,000. Our interest expense will be $33,350 in the first period. That is the bond's carrying value of $555,839 times 12% interest divided by 2, a 6% semi-annual rate, and that's where we get the $33,350. If we're paying $33,000 in interest but only giving investors $30,000, the difference will come from the discount of our bond amortization, or the amortization rather of our bond discount. The bond's carrying value will increase by $3,350 up to $559,190. If we've used proper anchoring in our amortization table, we can copy this row all the way down, highlight the row, grab the little square, and we can copy it all the way down. I'm going to just do it for 1 month or 1 6-month period now. Again, in year 2, we're going to make the same $30,000 payment. We'll make that throughout the life of the bond. Our interest expense, though, if you notice, has gone up from $33,350 to $33,551. This is because our interest is now the $559,190 times the 12% interest rate divided by 2. Or $33,551. And we will see over time our interest expense will increase as the carrying value goes up. Over the life of the bonds, we will pay the investors $300,000 in coupon payments. The interest expense on our bonds, however, will be $344,161. And why would investors accept less than $344,000 in interest expense? Why would they only accept $300,000? Well, remember, they got the other $44,161 up front. That amortized discount, again, equaled the difference between our interest expense and the cash paid to investors. We, in essence, prepaid the interest in the form of the discount when the bonds were sold or issued. Let's take a look at the payment of interest and related amortization on July 1st, 2020, as well as our year-end entry on December 31st. We'll take our first entry for July 1 from the first row of our amortization table. The entries for December 31st will come from the second row of our amortization table. On July 1st, we will pay investors a $30,000 coupon payment and record $33,350 in interest. We will also then, since debits don't equal credits, we will credit the discount on bonds payable for $3,350. On December 31st, we won't pay investors $30,000 in cash because we actually don't owe them the cash until January 1st. But we need to, from an accrual perspective, record the liability. So we'll credit interest payable for $30,000. We will debit interest expense for $33,551. Again, that's coming from the second row of our amortization table, as is the amortization of the discount in the amount of $3,551. The carrying value at the end of the year will come again from the second row of our amortization table. It's the $562,741. We carry the bonds on our books, though, always at their face value of $600,000, so we show the unamortized discount of $37,259. How much interest expense is recorded in the first year? That's the $66,902, the amount of interest from the first two rows of our amortization table. And our total borrowing cost over the life of the loan will be $344,161. That's the total amount of interest on the loan. Again, we've paid that to the investors in the form of $300,000 in coupon payments and a $44,000 discount when we issued the bonds. Let's now take a look at bonds issued for a premium. In this case, investors have an effective interest rate or expecting an 8% rate of return based on their assessment of our company's risk. If our bonds are paying a stated interest rate of 10%, these look like fantastic bonds. Everyone will want to buy them at their par value of $600,000. We'll have enough demand that we can raise the price. We will raise the price until we end up with an issue price of $648,665. Again, we calculate that by taking the 10% stated rate and dividing it by 2. The number of periods will be 5 years multiplied by 2 because it's a semi-annual coupon bond. And the payment will be the $600,000 times 10%, $60,000 a year, semi-annual basis, means the payment will be $30,000. And again, when the bonds mature, we will give the bondholders the full $600,000 face value. So when we issue the bonds, we will debit cash for $648,665. Again, we always credit bonds payable for $600,000. Debits don't equal credit, so we will credit a premium on bonds payable. Our amortization table starts off with the bond's carrying value. The cash paid will be $30,000 every 6 months for 5 years. Our interest expense in the first period will be the $648,000 bonds carrying value times 8% divided by 2. That again, we calculate interest expense based on the effective rate of interest, the market rate of interest. The amount of cash paid to investors is greater than the amount of interest they're expecting to earn, so the difference will be credited to the premium on the bond, and our carrying value goes down by $4,053 down to $644,612. If we've properly anchored our cell references, we can copy this row all the way down, and we notice at the end of 10 periods or 5 years, the carrying value of our bonds equals the bonds payable. We will have made total payments of $300,000. We will have recorded interest expense of $251,000. And again, the difference between the interest expense and the cash paid equals the amortized premium on the bonds. Let's go ahead and take a look at our journal entries on July 1st and December 31st. The entries for July 1, the first coupon payment, will come from the first row of our amortization table. The journal entries for December 31st will come from the second row of our amortization table. On July 1st, we're going to pay our investors the $30,000 coupon, and we're going to record interest expense in the amount of $25,947. Debits don't equal credits, and we will need to debit amortization of the premium on our bonds by the amount of $4,053. On December 31st, once again, we technically don't need to send investors cash, but we owe them a coupon payment. We're going to record interest payable of $30,000. We've got interest expense of $25,784. And again, that's for the period July 1 through December 31st. We're accruing our interest expense, and we will, again, debit the premium on bonds payable for the difference of $4,216. The carrying value of our bonds at December 31st will be from the second row of our amortization table. It's the $640,396. We carry our bonds on our books at their face value of $600,000. So how do we get to the carrying value of $640,000? We will show an unamortized premium of $40,936. Our interest expense for the first year will be the $25,947 plus the $25,748 for $51,731. The total cost of borrowing over the life of the loan will be the $251,000 in interest expense. The question is, again, why, if we paid investors $300,000, do we only have a cost of borrowing of $251,000? And that is because part of this $300,000 is return of the premium. Recall, they paid $648,000 for bonds with a face value of $600,000.